Is algorithmic trading safe? That's probably the most important question you should be asking. And if you're like most people, when you hear algorithmic trading, your first thought is probably sounds risky. Or maybe, is this even legal? Or what happens to my capital if something goes wrong? Those are exactly the right questions to ask. And today I'm going to be giving you the honest answers, not the marketing version, the real unfiltered version. By the end of this video, you'll understand exactly how your money is protected, why regulation matters, but not in the way you think, and what actually keeps your capital safe. Let's dive in. Here's what most people get wrong about safety in investing. Many people assume regulation equals safety. Regulation is important, but it's not the only factor that determines how capital is protected. If a company is FCA regulated, they assume their money is safe. If a company isn't FCA regulated, they assume it's dodgy. But that's not how it actually works. Let's give you an example. Woodford Investment Management was fully FCA regulated. Neil Woodford was one of the most respected fund managers in the UK. He managed billions of pounds for investors. And in 2019, his fund collapsed. Investors lost huge amounts of money. They couldn't access their capital for months. Some are still waiting for full reimbursement. Was he regulated? Yes. Regulation didn't fully prevent investor losses in that case. Now, I'm not saying regulation doesn't matter. It does. But it's not the thing that actually protects your money. What protects your money is custody. Who physically holds your capital and whether they can access it. That's what matters. So let's talk about how custody works with Oxford Equities. At Oxford Equities, we don't hold your money, ever. We're not an investment manager. We're not an asset manager. We don't take custody of your funds. We're a technology platform. We provide algorithmic execution software. Your capital stays in your own brokerage account, like Interactive Brokers, for example. Interactive Brokers is FCA regulated. They're one of the largest and most established brokers globally. Now, you can use a broker of your choice. However, IBKR is the most common across our clients. Your capital is protected under their regulatory framework, not ours. We simply provide the software that connects to your account via API and executes trades automatically. Here's what that means in practice. Let's say you open an account at Interactive Brokers or you connect your existing account. You maintain 100% control of that account. Your money never leaves your account. We simply connect to your account via a secure API, which stands for Application Programming Interface. The API gives us permission to execute trades, but it does not give us permission to withdraw funds, transfer money, or access your capital whatsoever. Even if we wanted to, the structure is designed so we do not have withdrawal access to client funds. Your money isn't in our system, it's in yours. Let me give you an analogy for this. Think of it like giving someone access to your Netflix account. You can give them permission to watch shows, but you're not giving them permission to change your password, cancel your subscription, or access your payment details. That's how API access works. We can execute trades on your behalf, but we cannot touch your capital. Now, let's talk about regulation. Oxford Equities is not FCA regulated, and that's intentional. Here's why. The FCA regulates investment managers and financial advisors. If you're managing client money, giving investment advice, or taking custody of funds, you need to be FCA regulated. We don't do any of those things. We provide technology. We're not managing your investments. We're not giving you financial advice. We're not holding your capital. We're providing algorithmic execution software that you control. That's why the structure differs from traditional FCA regulated asset managers. It's the same reason TradingView isn't FCA regulated. It's the same reason Bloomberg Terminal isn't FCA regulated. It's the same reason other large financial technology companies aren't FCA regulated. They're technology platforms, not investment managers. Now, I know what you're thinking. If you're not regulated, how do I know you're legitimate? Great question. Here's how you know. Your capital is held by by your own FCA-regulated brokerage like Interactive Brokers. Our performance is verified by third-party platforms like TradingView and TradeZella, which we covered in a previous video. We also offer a 12-month satisfaction guarantee, which means if you're not satisfied with performance, we refund your entire license fee. And here's the key: we trade these algorithms with our own capital every single day. If they fail, we don't just lose our own license fees, we lose our own compounding returns. We're 100% aligned on our interests. So let's talk about what actually protects your money. It's not regulation, it's custody. At Oxford Equities, you maintain 100% custody of your capital. Your money stays in your brokerage account, which is FCA regulated and offers FSCS protection on cash balances. You can disconnect the algorithm at any time with a single click. You can withdraw your capital whenever you want. You're in complete control. Compare that to a traditional wealth manager. When you give money to a wealth manager, you hand over custody. They control your capital. You hope they invest it wisely. You hope they don't lose it. You hope they're competent. Yet they provide very little transparency on where your capital is actually going, and you're not in control. With Oxford Equities, you never give up control. Your money stays in your own account. You see every trade transparently in real time. You can disconnect whenever you want. That's what actually protects your money. Now, let's address some common concerns. Concern 1. What if Oxford Equities algorithm disconnects? Nothing happens to your money. Your capital is in your brokerage account, not ours. We will work with you to reconnect it, but even if for some reason we disappeared tomorrow, your money would still be safely sitting in your IBKR account. You just lose access to the algorithmic execution software. Concern 2. What if the algorithm makes a bad trade and loses money? That's a risk with any investment, but here's how we manage it. The algorithm has built-in risk protocols. Every trade has an automatic take profit and stop loss. The algorithm refuses to trade when volatility is too high. Position sizing is controlled to limit exposure. And historically, the algorithm has a 73.9%, meaning nearly 3 out of 4 trades are profitable. But yes, losing trades happen. We're not going to be sitting here and tell you we're right 100% of the time, because that's simply not true. Since we have a profit factor of 2.54 and a win rate of 73%, we can be wrong a quarter of the time and still be very profitable. Here's the bottom line. Algorithmic trading is safe when it's structured correctly. That means custody stays with you, not with the platform. That means your capital is held by an FCA-regulated broker, not by us. That means you maintain 100% control and can disconnect at any time. That's how Oxford Equities is structured. We don't hold your capital. We don't take custody. We just provide the technology. You maintain full control. If you want to learn more about how the custody structure works, or if you'd like to see the API connection process during a live consultation, you can book a call using the link below. We'll walk you through exactly how it works, show you the security protocols, our live performance and track record, and answer any questions you have. Thanks again for watching, and I'll be seeing you in the next video.